Ladies and gentlemen of the crypto space, we're live on a Monday, March 31st at 11:31 a.m. We're off to a very volatile start. U.S. equities putting the fear of the crash into people. Clearly, that's noise rather than signal. Crash. We've gone over the definition of a crash. It's merely a reallocation of capital from one market to another, meaning historically, we would have a massive broad bond market rally, whatever, the entire yield curve. It just goes straight vertical with yields collapsing. So bear market, a crash is just a bull market somewhere else. Now it's a different consideration with regard to capital destruction, defaulting on debt or the paying back of debt. That's another story because that's capital destruction. But the selling of stock ain't shit. That's just the reallocation of capital. So I always tell folks the more interesting thing about a crash isn't the fact that overpriced pig shit is depreciating. It's where is that capital going? Now, obviously, we take into consideration if there is a significant destruction of capital rather than reallocation of capital, so that's considerable. Deflationary event versus just depreciation 30% in US equities. Where's it going? Without destruction of capital, whoopee fucking do. I'm more interested in where's it going. So that's more or less what's going on right now. And U.S. government has lifelines out for residential and commercial real estate, whether they're paying their debt or whatever the hell debauchery is going on at the FHA. Who knows? We get glimpses, but we don't actually know the subtle, granular details. We get media headlines, the myopic keyhole, giving us a brief snippet of whatever, because that's all it is. It's just so concentrated and myopic. It's static. It's a headline, whereas the reality of existence is dynamic and fluid and conversational. It's an ongoing progression of statements that can be made about reality. Like what is actually going on can never be captured by a static headline. And dare we incorporate the hyperbolic imagery, the picture associated with the headline. Oh man, all of this social media shit will drive people nuts because it presents an argument and an expression of an idea that's static. Whereas it's kind of like I did mention it the other day: international diplomacy and geopolitical foreign relations. That is the most incredibly dynamic thing. People are talking constantly and communicating constantly all day, and they'll throw up a headline like there's contention or someone saying something or someone's doing something. Meanwhile, literally, it's an ongoing conversation between dozens, if not hundreds of people throughout the entire day. How could you possibly capture all of that in a sentence with associated hyperbolic imagery? I mean, literally, people's brains are melting over this shit. So, anyway, that's the whole point of all this. Me saying things like this is while headlines and stuff like that are informative, it's more noise than signal. So, a lot of my perspective and what gives me comfort comes back to serenity, which I've talked about, and my tendency to be a reductionist. And it's really what are the fundamentals of what's going on? What can I act on? What can I not act on? And if I, and that's kind of like rule number one or rule number two. So what can I act on versus what can I not act on? So obviously, if I'm seeing headlines, I'm like, all right, this is information. What do I do with that information? Do I get emotional about it? Do I get angry, frustrated, or can I act on it? If I can't act on it, what we fucking do? It's just a headline. So I incorporate that into the gross set of data that I evaluate to give me information about what the hell is going on. That's it. Because I can't act on it. In life, that's all there is. Just the receipt of data. You're like, can I do something or can I not? And if you can't do something about it, it's something to worry about. So That's really the foundation of how I look at markets, and it gives me my serenity. And all this 240, 250 points down on the NASDAQ today so far, all these sensational headlines about the market's in a correction, the market's entering a bear market, and it's red, and Kramer's highlights, and this is anyone who would be buying today is insane. Yeah, I would say anyone buying equities today. I mean, is Nvidia going to go up 10x on the money and give you 10% APR? How could I just don't digest how that is the best of investments. I just don't get it. Which is completely separate and apart from it as a company and the products and services it offers, which are interesting. The greatest technology isn't always the greatest investment. Same exact thing with Tesla stock. What does Tesla stock do for you? Number go up. Boomer meme coins. That's how they are. If it doesn't pay you, if it doesn't hold the attribute, fuck you, pay me, it is merely a boomer meme coin in equities land. Fair back at 49 cents. DXY below the 100 SMA in the weekly. Now, this is a weekly chart, which is so important to understand in consideration of how I open the stream today. Everything that goes on throughout the week, all the headlines, all the potential things that you can or cannot do, and all the emotional effects that you may receive from the headlines is encapsulated in a single tiny line, tiny bar, tiny candle on a chart. Does this candle close below the 100 SMA? Does this candle close below last week's close? Or does it not? Why is that significant? It closes below the 100 SMA, that green line on the chart. Other people see that also. And that means something because if other people see it and you see it, then the whole world is responding to that actual reality, that average price, not a price in this instance, it's an index, but that average value is below a meaningful trend line. 100 ticks on this chart, 100 weeks, is the 100-week moving average for the DXY that closed below it because things either have a tendency to go up or a tendency to go down. Things have resistance, things have support. And candles matter. Follow-up candles. So follow-up candles build confluence. So right now we're going on week 5 of closing below the 100 SMA. So you got to see, you got to understand, the last 5 weeks we're looking for confluence that we're gonna stay below the 100 SMA. That's it, and it's 5 weeks, an entire month and a week of your life of headlines of tariff and the stock market's going to crash and whatever geopolitical insanity is going on. And merely, there's only one thing we're trying to ascertain. Will the DXY stay below the weekly 100? And then guess what? The whole thing starts all over again because now we have to tell a story about the weekly 200. That's all I do. And that's what brings me great comfort because so much of the world that we live in can be tied back to literally this stupid chart. I mean, other charts as well, because he built confluence cross data. But this particular set of data is at such the core of how global economics functions. It's just such an extraordinary piece of data because you have to also understand the nature of this data. It's predominantly euro and yen, but there's other currencies in there as well. But the other currencies are so dependent on the euro and the yen. So this is such a high level bird's eye view of so much information, not it's not obviously not explicitly depictive of what the hell's going on in Japan, or depictive of what's going on in Europe, or depictive of what's going on in Middle East or Ukraine or Russia. But everything is connected. Everything ties together. And when you take all that data and tie it together, everything affects everything. And this index is a manifestation of all of that data getting tied together. And this is the net result of just putting a whole lot of shit in a blender. And this is the outcome. This is the output. That's why it's such a meaningful chart. Now, people in social media will say many things about forex, foreign exchange, relative currency valuation, and they'll say other things have more significance, but that's not my point. My point is that I see this chart for so much more than what most people see it as because of the blender metaphor. And this chart really just piles the whole world into it in so many ways. Because then you have to consider what the hell is the significance of cross currency valuations. And then I could say that cross currency valuations is um, a forward looking indicator on geopolitical tension, trade wars. I mean, literally, isn't that's what I see. Now, maybe I'm that crazy guy, but that's what I see. If your currency in a particular country is, I mean, frankly, I mean, wasn't that the case for Japan in World War II? They had so much complexity because they're an importing nation and they couldn't get their supplies and materials, and that was the foundation for Japan doing what they did. And if we had real time data, and we didn't have forex markets back then, so you wouldn't be able to even have this kind of high level interpretation back then. But we have this kind of high level interpretation now. So the relative value of currencies literally plays into the equation of geopolitical tension. If a currency's value is falling and falling and falling, its purchasing power is falling and falling and falling. And that's exactly what it's been doing since 2008, where the dollar has been on a rip roaring rally for the last 14 years until 2022. Now, I'm not going to zoom out to 2008 right away, but then you have this. This is the result. Two pieces of information on this single chart from 2008 to 2022. Higher, low, higher, high. Pain after pain after pain for foreign nations that are completely dependent on access to dollars and their currency is depreciating. So that means they got to buy more expensive dollars because that is their most important import, as much as they need energy for respective nation state GDP. The whole point of the GDP is they have a capacity to buy dollars to finance their debt. The whole world has turned into a debt refinancing operation, as you guys are well aware by from discussions of Ralph Powell and the likes of Mike Howell. So if you reduce the whole world to a debt refinancing operation, their most important import is dollars, because otherwise they can't pay the debt. If you can't pay the debt, you don't have any damn GDP. You have no foreign relations. You have literally catastrophe and chaos if you don't pay the debts. Because then everyone gets mad at everybody and you get conflagration, that combustion point where everyone's mad at everybody. So this little circle right here just tells such an extraordinary story. If the dollar's straight up, generally speaking, between 2008 and 2022, this is the most massive congestion of holy shit, what the hell is going to play out in the last, I'll zoom out for that statement. I don't know, since .com. I bet that's not even really a congestion, relatively speaking. It's a couple of years of straight up and then basically straight down. Especially in the 80s, I was basically straight up and straight down in a matter of a couple of years. 5 years, give or take. One, two, three, 4, 5 years straight up and straight down. Straight up, straight down in .com. But this congestion is a different type. It's not straight up, straight down. It's just basically look where we are. We are at 104.28, and that's literally where we were back in 2022. Straight horizontal. Yeah, you guys are getting me excited. Or fine, I'm getting myself excited. That shit is crazy. That shit is crazy. All of that information from this stupid little chart. This congestion period is extraordinary, historically speaking. To top it all off, wick, this wick in 2022 is insane. That is massive wick. Now, obviously, there was a big wick back in '85, but it's a very different contextual situation, not only geopolitically with regard to globalization and deglobalization efforts, but just the structure of how the relative currency valuations has played out. Look at that place for the wick. Not only so obviously this was a shooting star, and this is very much a shooting star, but this is like delayed reaction shooting star by the tone of years, several years, going on 3+ years. Because it's not invalidated. This shooting star, I would say, is not invalidated yet. That's what makes it very unique, historically speaking, the history of the dollar, post $71. Until you get until you invalidate it by a higher high, I would say this shooting star is still in play, delayed by 3+ years thus far. And that remains my general expectation. Folks ask me what's my expectation for the next 3 months, 6 months. I'm more interested in what's my general expectation for the next 10, 15 years. Dollar down. And then you could be like, why? What is the geopolitics that allows that to occur? That's basically contention and boiling point and past point of no return with regard to debt servicing obligations, but dollar down. Probably first and foremost, for exactly the same reason tariffs are in effect. Deglobalization and repatriation of supply chain, the rebalancing of manufacturing. So that's why the dollar goes down, specifically because you have an entire United States administration policy that says the dollar needs to come down in order to meet policy expectations. Okay, okay, okay. I swear, I'll calm down. I'll calm down. Whew. Okay. All right, so that's the DXY. Basically, I start every crypto stream talking about the damn DXY because it tells us everything we need to know. Every crypto chart is noise. You don't need to look at it. Why? Because it's information overload. It's too much. From my vantage point of how I engage with markets. Obviously, you're trading Bitcoin. You need to look at the 5-minute chart of Bitcoin. So that's obvious. But that's not what I do. So I don't. So I this is what I do, and this is what gives me my comfort. It allows me to find my serenity because I have a perspective on where things are heading over the next 15 years. I mean, it's just wild the troughs, and the DXY did print lower lows between the 80s and 2000, and generally that is a decent trend line from a lower low perspective. Frankly, it's a lower low perspective from highs, or lower highs perspective from highs. Language. So see you at 68 in 2031. Maybe not because everything's been extended or things are weird and date ranges could be whatever. So 10 years, 15 years, 2035, 2037. Hitting exact dates is not the point. The point is trends and directionality that are a manifestation of the structure of the system, the overall flow of the system. The overall flow of the system indicates dollar down for many, many years to come. Yeah, Eunice is in the house. Good morning, Teddy. Good morning, ladies and gentlemen. John Doe. Yes, indeed. Good morning, Cap Mateo. Joel, hi. Some would argue dividends on stocks are funds that could be reinvested in growing the business. Yeah, I don't care. I keep it simpler. It's either you're paying me or you're not. And I don't. Do you care about the business? So is that why you that statement? I'm not saying you, Teddy. I'm just prosing, offering, a psychological or an argument. Oh, they should really reinvest in the business because that'd be good for business, strong business. Research and development, employment, take care of people. You're an investor. Do you give a shit about the business? That's my general statement. That's why rule number three exists. This isn't this isn't personal. This is business. And there's a very simple equation to business. And for me, it's simplification of the concept of investing. So that's why rule number three exists for me. Fuck you, pay me. I'm not interested in appreciation of the business. I'm not interested in your business. I'm not interested in how well you do or how strong you are, how productive you are, or how many employees you have. I'm giving you money. What are you going to do for me? That's the equation. Now, obviously, there's a sentimental and empathetic side to the captain, but that's not part of investing. Investing is cold and calculated. Have capital, want more capital. You have money, you want more money. Have investments, want more investments. It's mathematical. It's economics. So maybe it's not the best side of humanity, like the arts and the beautiful side of humanity, like love and relationships, but economics. Maybe it's hmm, yeah, I was going to say the rational side of humanity. It's certainly not rational, but it's the non-emotional side of humanity. It's the calculus of humanity. It's how things are coordinated, organized, how incentives are financed. So I don't care about investing, reinvesting in a business. If I invest in your business, what am I getting out of it, and when am I getting it? So that's my perspective. Hope that helps. Arrow, good morning, my friend. How are you? Heath, dollar milkshake suggests higher dollar. Well, okay. So Brent's right. I agree with Brent. Brent's, in my mind, is just unquestionably right. It's just remarkably obvious milkshake. What everyone fails to digest is time frames. Um, well, yes. If here you correctly are saying a weaker dollar helps global liquidity, the milkshake suggests higher dollar, higher risk asset price. Uh, okay. So how do we reconcile all of this? Cyclicality and time frame and flows. So, for instance, a weaker dollar is going to cyclically drive capital outside of the U.S. because foreign currency is appreciating, more foreign currency purchasing power. That means there's going to be an emerging market bid. So at least there'll be cyclicality from an emerging market cycle standpoint. I mean, that's just reasonable. Um, with regard to driving capital into that's literally exactly what happens in 2020. So the best expression of what Brent talks about is literally what already happened. So what already happened is a component of cyclicality and secularity. Those are two big words. So look here. We'll try and differentiate. This is cyclicality. See, you see that? That's cyclicality. And here's secularity. This is secularity. Okay. You have the cyclicality where it goes up, it goes down, it goes up, it goes down. But the damn higher lows, higher highs since 2008 to 2022. That's secularity. And you have that here as well. Plenty of cyclicality between 2001 and 2008, and the same could be said about 95 to 2001. And you could see. So that's secularity. Cyclicality is all the shit that goes on in between. So I would reconcile your observation with we literally just experienced milkshake cyclicality. And now we're about to experience dollar depreciation, which is also, we see demonetization of US equities, 1.15% on NASDAQ today. And it's down about 10%, give or take, which is such when quite a remarkable picture when you zoom out, right? So that capital is going somewhere. Where's it going? You don't know, but it's a valid rhetorical question. If it goes to foreign stock markets, foreign investments, those investments go up in price. And now you have a 10% down in NASDAQ versus a 20% appreciation in a lower market cap international asset as relative outperformance. Capital flows from underperformance to outperformance. What does that mean? That means if some shit's going down, you're probably going to sell it and you're going to buy the shit that's going up. That's what everyone does. That's why everyone says that's why everyone says do the opposite of what everyone does. But basically, what that means is you want to place your coins on the railroad track to where the capital is going. So when the train comes through, the coin's already on the track. That's basically a metaphor for like by the bottom, not by the dip, but by the bottom. So like if you see cyclicality with regard to international capital flows and a dollar depreciating environment, potentially see a boom in India, and you see some opportunities in India or Brazil or you know Southeast Asia, Asian markets, um, Australian markets. I don't know. There could be a boom anywhere because anytime capital flows, prices go up, and if prices are going up somewhere, prices are going down somewhere else, and someone sees that divergence, and that's an underperformance to outperformance type situation, that someone could see opportunity cost with holding a depreciating asset. Capital flows are funny. And your statement, Heath, is actually a really good statement that warrants all of this explanation. So it's both. Higher dollar could certainly mean asset prices go up. Lower dollar could certainly mean asset prices go up. Which assets? Which countries? What's the geopolitical backdrop? What's the backdrop of capital flows? Is capital flowing into or out of the United States? That's a binary thing. More capital flowing in, where's more capital flowing out? And guess what? That's just going to be cyclical for some period of time. And likely the way humanity's economic system works, it's over periods of years, capital flows in, and then some capital flows out because opportunity seeks the transfer of capital from underperformance to outperformance. Hope that helps. I believe stronger dollar forces central banks to ease, conflating two separate concepts. Easing, Fed has its mandate, which is very clear and unambiguous, and they've done decently well at it. Price stability and employment. Well, guess what? With the government layoffs, we've had the largest spike in layoff announcements. I think in history, certainly faster than 2020, and it was faster than 2008 as well. It's the largest spike in the data set. So the Fed's going to react this year. So all of a sudden, a couple of rate cuts that are not priced in are going to probably start pricing in um, as the Fed adjusts its dot plot. I'm not too interested in the Fed. I'm not too interested in rate cuts from the Fed. I'm more interested in rate cuts by the world. So the world offers rate cuts as well. It's just the Fed just governs interbank lending. So the bigger rate cuts that matter more is Treasuries, which is 10-year plus. So where are we at today? Minus 0.4%, 4.234% on the 10-year. You know what this chart screams? Cyclicality, baby. This chart screams topping pattern, particularly from a 200 SMA on the 6-month chart. This isn't even no monthly chart nor no weekly chart. This is the 6-month chart, ladies and gentlemen. And for the last 1, 2, going on 3 years, haven't gone above 200 SMA in the 6-month chart from a 10-year yield standpoint. And it's been going up for one, two, three, four, going on 5 years. Come on, cycles will cycle. It's the nature of nature. It's the nature of existence. Cycles will cycle. What goes up comes down. What goes down comes up. This has got to come down, not only because of domestic policy reasons. That's literally written over on the administration. You got $7 to $10 trillion that needs to be refinanced this year, and logically, they probably want to do it at lower rates rather than higher rates, and practically, they need to do it at lower rates rather than higher rates, and that means they have to drive down yields on duration, 10-year plus Treasury instruments. How they do it's another story. Implications, knock-on effects and policy, but they're clearly doing it to a degree. And frankly, there should be a little bit of fear if they don't get this down meaningfully. That's gonna that'll be an interesting inspection towards the end of this year. So don't worry about easing. The Fed is only control primarily of the United States, and you know this is a crypto conversation from an investing standpoint. So, yeah, while the United States is one of the largest actors, if not the largest actor economically on the planet, um, tiny, small country. This big world out there, and there's much more foreign currency. So, in a dollar depreciating environment, foreign currency increases in purchasing power, and that really changes things up a lot with regard to asset pricing. Most people, the most erroneous thing most people do is conflate the crypto market as a United States market, thinking it responds to the Federal Reserve and U.S. equities in a coupled fashion. Um, it is only loosely coupled to U.S. equities and loosely coupled to downstream knock-on effects of the Fed. Not coupled, loosely coupled. So, what's the coupling or the loose coupling? Sentiment. It's just sentiment. You think if you have a bull market, a raging, ferocious, exuberant bull market in India and Britain and Brazil, that's not going to bleed over into the crypto markets? Of course it is, because sentiment bleeds over. And guess what? Crypto market is not a US market, it's accessible to all markets. Therefore, if all of a sudden it's outperforming relative to a ferocious bull market in Brazil, or a ferocious bull market in India, or a ferocious bull market in Britain, um, and that ferocious bull market's like 10, 20, 30% in equities in those respective nations, and crypto's up 200%, crypto, quote unquote crypto, whatever, shitting crypto. It's going to bleed over because people are going to be like, oh, capital flows from underperformance to outperformance. 200% is more than 20, 30%. That's the coupling that needs to be digested. That's the reality that needs to be digested. Crypto is not a US market. It was never correlated directly to US equities, and it's only loosely coupled to downstream knock on effects, Federal Reserve activity. Hope that helps clarify a little bit. Therefore, dollar up and asset prices up, as Milche suggests. Yeah, don't look for a solution. Look for the dynamic reality of this economic situation and rewind a couple times and carefully digest the nuances I offered. It's not as simple as dollar up, asset prices go up. What asset prices? What country? Crypto's not part of the US. It's a global phenomenon. So asset prices aren't asset prices. You need to break it down. Are asset prices in Brazil going to go up because the dollar is going up? Or, so you need to be more granular when thinking about the concept of quote unquote asset prices. Therefore, dollar up and asset prices up, milkshake suggests. I think I nailed that. Sir Joe Present and it can't afford, sir. Yes, sir. Tano, will emerging markets and nations sell Bitcoin in the future? Well, that's obviously a relatively personal question for respective nation states. But what are they going to sell it for? Why would they sell it? Why would they buy it? These are great questions. Why buy Bitcoin? Significance of Bitcoin. Um, Frankly, the most in demand thing on the planet is dollars. Take out all the sentiment of, oh, the US prints dollars. Take it all out. Just take it out. The reason you take it all out of the equation is because everyone needs the dollar to pay their debts. What does that mean? You have to understand the composition of global debt. And you got to understand who has printed the dollar supply since 71, probably starting a little bit earlier in the 50s. So if China owes interest on dollar bonds to India, follow me on that one? So China issues a bond filled with a whole bunch of Chinese real estate. And they're like, here's a bond. India, pay us dollars for the bond. China gets dollars. India gets a bond. China has to pay interest on its bond in dollars. Okay, so they need dollars. That means they have to sell shit. So people pay them in dollars because they have to pay interest on that bond in dollars. Now take that to the world level. Every country did that with every country 10,000 times over. Every country owes every country dollars. Therefore, they must sell things for dollars to get dollars to pay interest on the debt. To such a degree, this has gone on for 50 years that the most sought after instrument on the planet is the dollar because they got to pay their debts. And this has nothing to do with the United States. This has nothing to do at all with the United States. This has to do with China and India, for example. Now, just obviously extrapolate that to the whole frickin' planet in the most epic spider's web you could possibly imagine. India back to China, China to Russia, China to Australia, Australia to South Africa, South Africa to every damn country in Africa, and then every country in Africa back to South Africa. It gets recursive. And then every country in Africa to Latin America, and then Latin America to Asia and Africa, and Southeast Asia and Europe, everywhere, back and forth, a spider's web, the most detailed, intricate spider's web you could possibly imagine. That's the dollar, not the US printing dollars. That's not the dollar. There's the, well, I've overstated this recently. The United States of America has printed $5.6 trillion in existence. Mike Howell talks about $300 trillion in. There's a difference between liquidity as he talks about it. It'd be an interesting statement from him how he could express what is the total supply of dollar liabilities. Because when he says 300, that's like financing capacity, liquidity as he defines it. Total supply of dollars, let's say, is 300 trillion on the planet. But the United States has only printed 5.6. Now, the United States has obviously leveraged that 5.6 and has $36 trillion worth of US debt. Even if you take that as the amount of dollars it has created, um, it's only 10% of the global supply. These are all just random ballpark numbers. It's clearly a lot more dollars in existence than 36 trillion. There's clearly a lot more dollars in existence than 5.6 trillion. So how do those dollars get into existence? By that entire spider's web that I just told you about. And that, my friends, is called the Eurodollar market. And that is why the dollar is demanded everywhere because it has nothing to do with the US. It's a debt that every country owes to every country. And if you don't pay that debt, every country is mad at every country. You just didn't pay that debt. That doesn't work. And there's no component of the United States in that equation whatsoever. You follow me on that one? That's very important to understand. Hope that helps. Uh, what else did you say, Tano? Following the arrest of Istanbul mayor. Yeah, I saw that. The central bank of Turkey invested stabilized by selling 20 bill Bitcoin. Okay, so when push comes to shove, anything that's not nailed down gets sold. All right, that's just the fundamental requirement of capital management. Um, I'm not too interested in the Bitcoin price. I think it's mostly noise. Um, but the signal there is at some point everything gets sold. $4. So they sold the Bitcoin $4 to buy the Turkish lira to prop up its price. Okay. See how the dollar was in that equation, which is more important takeaway than the selling of Bitcoin because it could be the selling of anything. It's just it's interesting actually that the Bitcoin is what's most liquid and in demand. Someone was willing to give them dollars for the Bitcoin. So that's interesting. Eunice Cap, can you enlighten us what it means that the dollar goes down the next 15 years? What new opportunities will arise from this? There's going to be a tremendous amount of cyclicality along the way. There's always cyclicality. We can look at the DXY and we highlight significant periods of cyclicality on the secular backdrop of a dollar bull market between 2008 and 2022. Dollar down structurally should cyclically allow international asset prices to be monetized, whereas domestic US assets relatively demonetized. Stronger international currency, but then again, you have the milkshake concept. So stronger international currency does not entail investment outside of the US. So there's a lot of factors in the equation. Just because foreign currency is stronger, the concept of investing still remains underperformance to outperformance. So you'll have a cyclical period of dollar down and demonetization of foreign equities, and everything in the United States equities market's ripping. That means foreign currency is going to be piling into the United States, which means the dollar may have a cyclically weak down period. Because in order for foreign currency to invest in the United States, it must first purchase dollars to then purchase equities. So, and this will all play out in the charts. You'll see the dollar start to go down after a period of, so okay, so the dollar goes down, strengthens foreign currency, and then there's a bear market, and geopolitical conflict or internal conflict causes GDP drop and equity sell off in India. So the dollar went down, strong foreign currency, and a weak equities market. All right, fine. Those investments may find their way back to the United States, and you have a bull market in U.S. equities with a dollar down period. So you can see almost anything can be explained by these knock-on effects and interplay of financial activities, and that's the point. The point is when we talk about this interplay of financial activity, it's not from a prediction standpoint. It's from a tool set available to you to understand what the hell is going on now, today. I'm too interested in predicting too much of the future. There's so much effort that people spend on trying to figure out what comes next. Now, you can only get really high level glimpses of that. And that's why I don't really state very concrete things, nor am I interested in making long term projections or predictions. Only when something structurally makes sense will I state something assertively, which is probably the only thing I say with a great deal of strength is it makes a whole lot of sense for this to secularly reverse. And it frankly is just harmonic. Goes up, comes down. What goes down goes up. It makes sense for this to go down for geopolitical reasons, deglobalization reasons, repatriation of supply chain reasons, and it has been explicitly stated by United States administration policy reasons, which implies there'll be cyclicality with regard to Bitcoin, cyclicality with regard to emerging market asset prices. I don't know. That's kind of the thing that you'll inspect day to day. And what's the point in uh, pro, pro, see that plays into I don't treat Bitcoin as an investment. Maybe I just don't give a shit uh, to to think about how that may play out. I can't. It's much simpler for me. Okay, Logic suggests dollar down over the next 15 years, own Bitcoin. All right, so done. What does that mean for me? Bitcoin's part of the cash position. Bitcoin and stablecoins, cash. So now the next part of the equation is how much Bitcoin relative to cash. Gotta have cash. So this is all a personal subjective thing. How much Bitcoin versus how much cash? You want exposure to Bitcoin, you want to own something. You don't want to own too much, you gotta have cash. You can't spend all your money. So that's how I digest, like, or how I reconcile why I don't care about the Bitcoin price because I generally expect it to appreciate over time. Um, but it doesn't mean too much to me from an investment standpoint. I don't factor its appreciation into the significance of my investments. I factor much more so the dollar into the significance of my investments. Anyway, that's a bit of a loaded couple of statements I made. Hopefully, that's insightful into the way my mind thinks. What new opportunities will arise from this? Dollar down, foreign currency appreciates. Global dollar supply is going to significantly increase. Global foreign currency supply is going to significantly increase. All of it heads on chain. $270 billion worth of stablecoins in the crypto space will lead to 2.7 trillion, will lead to $27 trillion. Over what time frame? I don't know. I don't care. It would be higher highs and higher lows with regard to dollar supply in crypto. Therefore, more financial activity. More financial activity will be monetization, higher prices of crypto assets broadly. So, what are the interesting crypto assets? That's why I talk about the five businesses. The five businesses in crypto are the most interesting way to have exposure. I hope that's simple. I know that's a lot, but feel welcome to ask any follow ups. How do you think new enterprises will engage with Curve? To be honest, I can't envision them bribing for LPs. I don't think we have a sense of what the hell is going to play out. We'll only have a sense when we get a significant inflation of dollar supply in crypto markets, because then choices can be made, decisions can be made. So ultimately, what do we know? We know it's a B2B product, forward rentals, the capacity to finance liquidity efficiently. So it's much more cost effective cyclically, and you go between convex and curve, between vote market and Vodium. We've seen that play out. We know it's a B2B product. So what happens when 270 bill turns into a half a trill, turns into three quarters of a trill? And now there's new capital available for new protocols and new businesses to get off the ground. And they have tokens and they want liquidity. Okay, so we won't know until we see the significant increase in currency supply, because then and only then will choices be made with regard to capex, regard to capital expenditures, and what these new businesses, new protocols will choose to do in order to achieve their objectives. They need liquidity. Why finance it themselves when you could finance it efficiently? So that's my 2 cents on that. Can't envision it now, but when there's a significant increase in currency supply, that's when we could not only envision it, but start to see whether it materializes or not. Is this B2B product not used? Why would it not be used? Why would it be used? You'll only know when the increase in currency supply occurs. Good morning, Cap. Much a pleasure, DCA man. Peter P in the house. DeFi dot money versus cross curve. Which one is more interesting? Both are technologically interesting. DeFi dot money is currently uninvestable. Cross curve is investable, albeit it is an emissions protocol. So sometimes that takes years to get to that critical threshold where emissions taper off to such a degree that you could have a relatively stable asset pricing. They're both great tech. Great tech is not always the greatest investment. Um, there is no possible way to answer that from an investment standpoint. Certainly, from a tech standpoint, both are very interesting because both facilitate seamless cross chain liquidity, whereas DeFi.money facilitates liability printing, which is an actual business. I guess, well, cross curve facilitates foreign exchange. Two different businesses um, to consider. Frankly, both are interesting, period, if we want to leave interesting unto itself as an open ended statement. I would say they're both interesting. Eunice, love you, sexy, soothing financial analysis cap. It is much a pleasure to talk to you guys and gals about all this shit that goes on in the captain's brain. Understood, Cap. Will this spider's web ever get less dense? Um, so that's a great statement, but you're talking something secular and something highly long term. So the only way for the dollar to truly reach its end state, milkshake style, or reach its end state, period, whether so the milkshake is the debts get paid back, and for the debts to get paid back, the dollar goes straight to infinity and beyond, straight up. Um, I think that's just the end state, period. So I'm pretty much aligned with milkshake. But the point is, for that spider's web to get cleaned up, either the debt is paid back, which doesn't make any sense because no one pays back their debt, or it's defaulted, in which case you have the potential for a 2008 liquidity cascade and geopolitical crisis, because that's when backs get put up against the wall and countries are put in a place where they kind of have nothing to lose and things are falling apart really quickly. That's the stage where tension rises. Um, I don't think it gets paid back, so I don't think it just dissolves over time. I think either you have the crisis where the spider's web, you know, starts to fall apart, and that's crisis, or or it just keeps getting more dense and somehow miraculously uh, morphs into something else. W- I this is why I don't think too much about the end state. When is the end state? 30, 40, 50 years. This whole perverted system could continue on for much, much longer than anyone thinks. Debt can go much, much higher than anyone thinks, and then they could literally be denominated and do a whole bunch of other financial fuckery to make things appear like it's not. Spider's web is not as dense as people think it is. So it just This is why I inspect shit daily and I focus on one thing and one thing only: understanding the market and what it's doing today, and identifying what I care about, what is interesting to me, differentiating between what I could something I could do something about and things that I can't do anything about. And above all, serenity. Serenity meaning look up the serenity prayer. And as long as I could take care of the things that I know I could take care of, I'm good. Anything outside of my control is outside of my control. And it's not something to worry about. Don't spiral too much into things that are outside of your control. Tends to be very frustrating and destabilizing. Curve back at 50 cents. That's nice to see. Where's the dollar? Dollar bumping up 0.28% with curve up 7 and change percent. It's nice to see it at 50 cents. It was up at 60 cents just like 5 minutes ago, 3 days ago. But this is constructive price action. Bitcoin 83.4. Yeah, I think we're yet to see crypto really rallying on a downward leg of the dollar. So look, Bitcoin's up 1.24%, and crypto broadly is up today, with the dollar up 0.3%, smacking right into the 100 SMA. So we're still in a period where dollar appreciation is boosting crypto prices. Albeit, look, dollar appreciation and the equities market's doing what it's doing. So there's a bit of an inverse correlation there, at least from a today's inspection standpoint. What we want to see from a crypto market standpoint is significant dollar depreciation, a breach below the 200 SMA while crypto is outperforming, because that indicates foreign currency is appreciating. You got an emerging market cycle going on, and investments are pouring into crypto because of that increased purchasing power outside of the United States. And that, historically speaking, ladies and gentlemen, is the most favorable conditions for crypto. Why? Because of this. Look, you can look back at this giant history, it'll drive you nuts. And then you're like, where was crypto? Just here. This is the entire history of crypto, basically. Relative the modern crypto in a nutshell. And if you go here, and then you go here and go here, we get a guppy draw. Here's your two crypto bull markets. One, two, period. Those are the crypto bull markets. When people talk about 16, 17, when people talk about 2020 and 2021, it's the red guppies. That was the period of weirdness in crypto market. So at least historically speaking, you kind of want to see that again and assess if red guppies, a significant depreciation in the dollar is playing out again. I mean, ultimately speaking, because of what you mentioned earlier, Heath, there's plenty of scenarios where a depreciating dollar does not cause significant appreciation in the crypto markets. So we'll have to really inspect that in real time as things play out. But history says that's probably what we're looking for next to see highly favorable conditions in the crypto market. Red guppies, significant dollar depreciation, lower lows, and breath to the downside. And day to day, we'll be able to say more so specifically what's going on. Anyway, what else can I say today? That's crypto market in a nutshell. I give you 2 cents on my proposal for a curve. Now, this is going to be a highly contentious proposal. It's probably not going to do anything. I don't think anyone's going to. I don't. There's no. Let me try and frame what I'm thinking. So this is a nice analysis of what this all means. It's nothing to do with curves, nothing to do with the contracts. It's a legal concept called nominee interest. Now, what does that mean? It means that the fee distributor contract holds title to collected quote unquote fees, crypto fees, for the benefit of people that claim it, which means the contract doesn't own it, nor does Curve, nor does the other contracts that are, that Curve built. What is a contract? So, what is a smart contract? These are discrete entities, separate entities from one another. It's literally just a piece of software, but it's an encapsulated piece of software with inputs and outputs. So, bear in mind, it's also a contract, which is very much comparable to a written contract. A written contract defines everything about an entity. So, these are discrete entities, which I think is a pretty strong argument because it's literally written to the blockchain at a specific address and it has specific inputs and outputs. And one contract cannot affect another contract other than by predefined paths, predefined interactions, pathways, APIs, functions. So these are very isolated, discrete entities, these smart contracts. So this particular contract, the fee distributor contract, I would like everyone in the current partnership to say officially it has nominee interest. Now, here's the thing, it inherently has nominee interest because it's isolated and no one in Curve you can't go into it and take capital out. Nobody, none of the partners, you can't take capital out. You can only claim what it says you can, which is your pro rata share, your proportional share based on your governance ownership in the partnership contract, the voter escrow contract. So nominee interest is inherent. It already exists, and this is maybe a proposal of awareness and memorialization, such that a governance vote you could present to inspectors, you could present in a judicial setting that everyone agreed it has nominee interest, but it actually inherently does. So in some my documentation, I talk about the inherent existence of nominee interest. Now, what else could I say? aside from this particular proposal, which is entirely focused on nominee interest, clearly to understand what that is, you have to inspect the thoughts going on in my mind why nominee interest is significant. Now, documents at about 27 pages, the voter escrow partnership, it's going to be contentious. Everyone's going to have a billion and one opinions about this shit. But the point is, this is a manifestation of what I see based on reading the IRC code and case precedents. Case precedents is all the shit that's gone down in court cases since basically the beginning of time. I got court cases going back to the 1920s that say basically that substantiate what I'm saying, that say what I'm saying is reasonable. Everything about law is about reasonable. What is reasonable, rational, justifiable, it's substantive, so on and so forth. So everything in law is an argument for or against the position. So what you do from a law perspective, a legal perspective, is you present argument. Now someone comes up with a counter argument, and then you fight about it back and forth, throwing around precedents, throwing around justification, throwing around rationale, and ultimately someone has to judge. Okay, great. We have an entire system called judges, called the judiciary. That's the whole point. That's the way the legal system works. So in that regard, this is a valid argument. Um, yeah, let's go partner. Put it here. It's a valid argument because it's a constructed argument with an introduction, a premise, a point, conclusions, takeaways, implications. Now, this is a favorable argument because this has favorable tax treatment associated with it. Reception to it is going to be contentious, both from an accounting standpoint and from a regulatory standpoint and from a judicial standpoint, albeit I frame this document not from an accounting standpoint. Accountants are like, all right, IRS, what are the rules? What are your rules? But it's not really rules because all they do is have a job, and their job is to interpret the words of Congress and collect. They're just a collections agency. The same one that calls you for your credit card bill. It's just a collections agency based on the words of Congress. So what do is I break down the words of Congress. I don't break down the words of the IRS. In a post Loper Bright, and that was that big case last year in 2024, the words of the IRS mean little compared to the words of Congress in the IRC code. So if you inspect the words of Congress and frame an argument, you have great strength in your argument. So there's a whole lot of unknowns associated with this positioning, particularly because this partnership ha- it has all the properties of a partnership, and that's the most important thing. Has the properties of a partnership. You literally have all these people that have bought CRV and locked it as VECRV, and they're all voting on governance, making choices and decisions. That literally, by any inspection, is a partnership. Now, there's a whole bunch of implications to that and knock on effects and downstream things to consider. But if that's a partnership, therefore, and this is what led me to this document, like, that's a partnership. All right. What are the laws related to partnerships? Okay. So that's what led me to this document. So the laws of partnerships are there in the IRC code. There's a whole lot of laws. It's basically what subchapter K, IRC 701. Is it? Is that the start of it? Subchapter K. Yeah, 701 to 771. Partners and partnerships. Subchapter K. Here's the laws for partnerships. All right. So I read the rules and I'm like, all right, is this a partnership? Well, yes, very much so. This is a partnership. Here's a couple of cute ones. Mm, no, it actually gets how many pages to get to the escrow? About 5 pages to get to the escrow contract. Let me see if I get you a cute little quote. Bear with me. Oh, anyway, I don't know where the quotes are. But maybe it's maybe the counter arguments will have a decent quote. Yeah, here's a good quote. Iris, good, great. It's the first counter argument. Practical guidance here. IRC 7701A2 defines a partnership. Here, let's do this. 7701. A2. The term partnership includes a syndicate, a group, a pool, a joint venture, or other unincorporated organization through or by means which any business, financial operation, or venture is carried on and which is not within the means of this title a trust, estate, or corporation. All right, great. It's definitely not a trust, estate, or corporation. And the partner is basically us. But look, syndicate, group, or pool, joint venture. Let's focus on these three things. That's what the voter escrow contract is. It's a syndicate, a group, or a pool. Just a whole bunch of people doing some shit. So literally, by definition, by the words of Congress, the partnership. So that's a big deal because the partnership laws get pretty interesting with regard to um, tax liability of the partnership. So tax liability of the partnerships governed by IRC 702 with regard to it's a pass-through entity, which means revenue of the partnership, the pro rata share of the partner is taxable income. But the reality is, here's the start of this. The reality is the partnership doesn't make any money because what is income? And that comes in, this is where I break it down. Uh, 'Cause it's all about Glenshaw Glass. This is not Eisner McComb is more capital gains, but Glenshaw Glass is like the the landmark case that defines income. I don't have the quote. Let me see if I have the quote. Yeah, this is the landmark quote from the landmark case. Hey, here we have instances of undeniable accessions to wealth clearly realized over which the taxpayers have complete dominion. Dominion. So in this instance, we're talking about the partnership. So complete dominion is a great is where you go next with your analysis and argument. So what does dominion mean? Capacity to control, access to, a capacity to invade, where the partners of the partnership can go into the escrow contract and make choices and decisions discretionally, not taking like personally, like stealing, but like according to the partnership, you have board meetings and you could just take some of the money that's in the escrow contract and reinvest. There's no dominion. This is all separate entities and it's all implicitly, indirectly governed. Why is that important? The voter escrow contract is just making, it's not making choices about what to do. It's basically updating a set of rules. And those rules are interpreted by complete separate entities. So downstream contracts and the escrow contract are reading the information from the voter escrow contract only. It's not like what the voter escrow contract does is modifying or invading or changing the composition of the escrow contract. In fact, if you look up the escrow contract, it's immutable. So it cannot be modified, it cannot be invaded, so on and so forth. So the the control goes upstream from downstream, where the voter escrow contract does what it does, only interpreting the changing information from the voter escrow contract. So in that regard, the nominee interest in the escrow contract means that accumulated property is not accessible to the voter escrow contract. certainly not accessible to us as partners other than one specific thing and one specific thing only, the claim function. And that's the whole point of the argument. All we could do is press a claim button to access the voter escrow partnership from a partner perspective. And therefore, if the fee distributor contract, which is the escrow contract, contains property and has nominee interest, it's entitled to us. So it never receives the property. It receives the property on behalf of us. So the second property enters the fee distributor contract, it is already entitled to us. It just not just has yet to be distributed to us. So the next step in the equation is okay. So there's no dominion because the only thing that can be done is that accumulated property can be given to us, but it's not like it has nothing to do with the partnership and fee distributor contract uh, wasn't funded by business activity of the partnership. That's another key consideration. It's not like this is a business. We call it a business as a metaphor. We call it fees as a metaphor. But what is, and that's the entire introduction here. That's all page 0 through 5. It's the nature of smart contracts. There's no business offered by Curve. People are engaging with one another in a peer to peer fashion. Now we come back to the origins of the concept of blockchain technology and peer to peer financial transactions. And that's the whole point. So, as a result of downstream contracts, not the voter escrow contract, that facilitates these peer to peer interactions, John interacting with Jane, that interaction results in some property being escrowed in the fee distributor contract. Now, that property is a new property. It wasn't created. That property isn't money. It's literally property. It's just the redirection of a portion of property, the original property that was contributed to the system by John interacting with Jane. So it may appear like a fee, but a fee implies dominion, and a fee implies a product or a service offering of a business. But these are just people interacting with one another. So what you have is basically the third, and this is this case. This case is so, this may be the linchpin case. Um, Commissioner versus Bollinger in 1988. Actually, maybe the linchpin case. So this has to do with property entering an escrow contract with nominee interest and basically clarifying that its distribution to the beneficiary is not a taxable event. It's just a distribution of property that's in the escrow contract that's already entitled to the beneficiary, which is us claiming it by pressing the claim button. Now, the core argument maybe of this entire thing rests on um, maybe this paragraph. So I should probably enhance this paragraph. Bollinger does not mandate that the beneficial owners personally contribute the property. So all the Bollinger case does, and I have to read it another 50 times to be so remarkably clear with these arguments. What Bollinger focuses on is the distribution of property from an escrow with nominee interest to the beneficiary, the entitled partner, does not constitute a taxable event. And it does not distinguish the source of the property. Now, traditionally speaking, and this is an attackable argument, partners contribute property. So the logic is that us as partners contribute property and we could distribute it property to escrow and it could be distributed tax free. It's just basically the musical chairs of property, unrealized property. So the core of my argument is that Bollinger never said it had to be partners contributing property. Never said anything about that. Could be third parties, and that's exactly what John and Jane are doing when they're interacting with one another. They happen to be putting some property in escrow for us. That's why it's important to clearly deconstruct that it's not a fee because there's no dominion or control per Glenshaw Glass. And that's why the Bollinger case is a linchpin because it's an escrowed property voluntarily contributed by two people interacting with one another. And the distribution of that property from escrow to us follows the rules that are discussed um, in Bollinger for the distribution of escrowed property to partners. Anyway, so that actually is a pretty in, as clear as verbal clarification gets. That's pretty succinct. There's obviously a lot more to it, and there's obviously 27 pages of counter argument, rebuttal, court case precedent reference, and I break down like basis preservation. So what's the basis? But we all need to know our basis. So it's a big section actually. And this is going to be contentious from an accounting standpoint because clearly um, the DeFi protocol cannot submit a Form 1065, but I try and deconstruct that as best possible. Non-standard tax administration can't file a 1065 and can't issue K1s software. So in a post-low bright world, I find the IRS is going to be like, the partnership didn't submit 1065, all right? And then I'm like, all right, so hey, Congress, what do we do? It's not up to the IRS. So that's exactly why this argument is structured as a legal document, not as an accountant's document. What do you do? Nobody knows what to do. That's the whole point. Why is it a judicial document? It poses the question. It presents the question. All right, great. It's a damn partnership. I can't file a 1065. Hey, Congress, what do you do? Um, and frankly, that argument is completely consistent with the history of tax reporting, substance over form, great court case references, um, and the reconciliation is pretty simple because there's other examples in IRC code and traditional IRS tax treatment where, um, like a gift, the gift retains basis. Okay, so there's an example of retaining basis. And another retaining of basis is distribution of property in a trust setting. It retains basis. All right, great. So this is a scenario where basis is retained. So independent of the inability to file a 1065 or K1s, all right, here's how the rest of the law applies. We are This document breaks down how to respect the law as best as possible given the way the law is written. And it proves that it does. Even though a 1065 isn't filed, the partners have a capacity to have basis, have a reasonable basis based on the technological limitations of crypto. So you have, and that means subsequent transactions or the subsequent basis treatment and taxation of distributed property to partners can be tracked, it can be managed, and can adhere to subsequent rules regarding capital gains. Eisner versus Macomb, which is the landmark case for capital gains. Macomber. I always cut that short. Eh, anywho, I don't know. I am not too fond of. I've rather said I am fond of being crafty, innovative, doing things differently. As you guys are well aware, with market volatility from an investing standpoint, I have little to no fear. Not about fear; it's about understanding, because the understanding of shit alleviates fear. So I'm like, all right, this is actually the way the law is written. So but there's no fear to be had. I am literally digesting, understanding, reading, and respecting the law as written to the best of my abilities. Therefore, I'm literally doing the right thing. And that is by definition what Form 8275 is for. It's for disclosure of information. Basically, that says where that document I could use to say, I am doing what I'm doing because of this explanation. And this explanation happens to be favorable from a tax treatment standpoint. So, as I've said in earlier streams where I've discussed property receipts, trust setting, and stuff like that, tax avoidance is completely reasonable. Why? Because follow the law. The way the law is written, you could structure your financial activities um, however you see fit, and the tax implications mean little to nothing. Some good quotes on that are here. Um, Avoidance reflects statutory form to lessen immediate tax liability. These are all direct quotes. Form absent exceptional circumstance reflects substance. Persons may adopt any lawful means for the lessening of the burdens of taxes, which in one form or another may be laid upon property or profits. Lessen immediate tax liability is Weeks versus Sibley. Direct quote, internal revenue creation of trust to lessen tax liability held legal. All right, this from a trust setting, but the point is tax avoidance is quite reasonable. Just follow the law. And that's the whole point of the IRS. What's the law? They're interpreting the law as written by Congress. All right, so fine. I'm going to read exactly what Congress wrote, and I'm going to follow the letter of the law. And that's exactly what this document is. It follows the letter of the law to navigate the reality that this is strongly a partnership. All right, great. If that's the base, then what? Now what do we do? So frankly, I should probably add, in typical me fashion, I should probably add an entire section about congressional questions. What would I ask Congress? What do I do in this situation? How do we reconcile this? What is reasonable? And that would be an interesting section. Like the whole point of this document is not too interested in. I mean, clearly, I'm going to be interested in what the IRS has to think if that type of scenario ever occurs. But the point is, I'm not talking to them. I'm talking to Congress through them because in the end, all they're doing is interpreting the words of Congress and following the rules of Congress. And I appreciate that perspective and that actual reality. So accounting, you're never going to, the odds of you finding an accountant that's going to execute this type of treatment, I don't know. That's not the point of the proposal. The point of the proposal is nominee interest, which memorializes a lot of what I talk about in the document. Doesn't really do anything, but obviously it brings awareness to this document, which I made public, so people could do whatever they want. And people are going to have a variety of opinions on it. A lot of folks are going to be afraid and fearful and be like, oh no, I can't file a 1065. Whereas I'm like, all right, I can't file a 1065, which brings the question, what do you do? Not us. That's a question to them. What do you do? This is a partnership. Now what? What is my instruction of what to do? I'm telling you that I can't file. It's not for me to file, it's for the partnership to file it. So if the partnership can't file it, what do you say? Is the partnership not in compliance? All right, great. Well, that's the whole fucking DeFi space. Well, you haven't done anything for 15 years. So now what? Now what do you do? And then they're asking a whole bunch of internal questions, but this isn't about the partnership. It's about me and my compliance with my reporting. So now they get into a whole internal tussle over scale and scope of conversation. Am I individually responsible for a partnership? No, that's not reasonable. I'm responsible for my own individual reporting. So am I respecting the what's it called? The intent of the law. And that's exactly stuff that I talk about. Intent. Can I still maintain intent of compliance? Partnership duration. Where the hell did I put it? Non-standard tax administration. Here, self-reporting enabled by blockchain transparency. All right. Partnerships' inability to file Form 1065 or Schedule K1s stems from its reliance on automated smart contracts which lack a centralized administrator. Yet this does not undermine compliance with IRC 6031B, which requires partnerships to furnish partners with information to compute the distributive share. Why? The blockchain's transparent, immutable ledger fulfills this requirement by providing real time verifiable data on each partner's pro rata share and distribution value. All right, great. So the K1's supposed to say how much I got. Meanwhile, I know how much I got, so I could report accurately. I have that information. So the user interfaces integrated with the protocol automate the compilation of this data, enabling partners to access self-reporting their tax obligations accurately. All right, so great. So that is a very reasonable statement. All right, the partnership couldn't do what it's supposed to do. I can still do what I'm supposed to do. What say you? And it happens to align with precedents, Horn v. Commissioner, where the court required reporting of income when the taxpayer had a right to receive it, regardless of formal documentation. So this is a very obvious and useful precedent. All right, so it's like a 1099. How many people here have like gardeners or employ a handyman or something, or just ask someone to mow a lawn or whatever? You're literally supposed to file a form 1099, especially if it's like weekly. And if you don't, technically there's liability, supposed to be liability if you don't file the form 1099. But the recipient is still responsible for filing, and that's exactly what Horn v. Commissioner said. You see the point there? So it's the same thing with the K1s and the particular IRC. The K1s and 10, I forget, it does 6031B. Specifically the same thing with regard to the K1s and 6031B as a 1099 compared to individual filing requirements. So anyway, that's it. Substance over form. Um, we should have a, was it Helvering? Helvering. Yeah, Gregory Helvering is pretty much landmark case for substance over form. Ah, making a mess. Pretty good. Okay. I just wanted to bring back the case reference, albeit Culberson might be better in that it's substance over form is Gregory Helvering talks about tax treatment more so maybe than justifying substance over form, whereas Culberson is a little bit more contextually relevant here. Anyway, so that's what this document does. If anyone has any questions, I don't know. I'm happy to explain as best possible. I know folks are either going to like or dislike it. Most people are not going to do anything with it. That's not the point of making this document available. The point is it's a production. It's like a poet writing his poetry or an author writing his book. They made this. So folks could do with it what they want. They could be critical of it. They could help me with it, enhance it, run it by accountants and attorneys and get all sorts of opinions. So have at it. This is a production of me, from me. Let's wrap it up for today, Monday, March 31st, 1 p.m. in the afternoon. 253 people made it to the end of the stream. I appreciate each and every one of you, and you are all now a little bit more rational because of it. It's a Monday. I think I'm not going to be with you on Wednesday, but I'll be back on Friday. So stay rational until then. Keep calm, cool, and collected. Rely on real time data to make the best decisions possible. Don't worry about things that are outside of your control, and anything that's inside of your control, make the best decisions possible. And that's how we do things right on life. Until later this week, I will see you. Peace.